Well, good evening to you all. It's fantastic to have so many people online. We are really excited this evening. We've got a huge amount of information to impart. And yeah, I've got two of my partners online, both Brendan and Henny. So I've made them both organizers. So if you want to fire through questions, they will be able to see what is happening and what is going on. I also want to thank everyone who took the time to write down what it is that you're wanting to achieve out of tonight's webinar. Huge amount of detail which I've been through. I'll try and answer as many of the questions as possible, but should I not, please feel free to put your hand up and to ask a question, and I'll either try and answer it then or certainly we will answer it later. I'm not going to go anywhere later this evening, so we will have plenty of time to be able to answer it. So thanks to everyone who took the time to put that down. It's awesome to have so many of you online. And without further ado, it's another Let's Talk Property, and I want to basically look at tonight. We're going to focus on the 7 fundamental trends to growable property and wealth, scenario planning, where to invest, and in what. And it's all based on a gentleman by the name of Clem Sunter, and I'm going to go into quite a lot more detail in terms of Clem Sunter and what is actually happening with that. Now, where do these 7 trends come from? Well, the first part of it comes from personal experience. We've helped over 2,000 people invest in international property to a value of 1.6 billion. And certainly from doing that, and also a huge amount of personal investment myself, I bought my first house when I was 22 in South Africa, my first house in London when I was 24, and I did my first development when I was 26. And so we've been playing in the offshore space, the international property space, for a long time, and really just wanted to share with you a lot of the lessons that we've learned, and particularly some of the big lessons we learned from the global financial crisis. The second thing that I am extremely excited by is that in the game that we play, where we help people invest in international property, we only tend to deal with high net worth investors. And they often say that when you're hanging around the right type of people, you're going to learn the right type of lessons. And certainly for me, that is one of the most important things. And some of the best lessons I've learned are from dealing with some of the most sophisticated high net worth investors, both in South Africa and internationally, and learning from them, seeing what they're doing, seeing the type of strategies that they're using in these type of markets and these type of conditions. The third one is Real Estate Investor Magazine. Neil Peterson is the owner and publisher of that. We do a huge amount of work with Neil, and we've actually just been involved in a workshop with Neil where he brought out Dr. Dolf de Roos. Now, Dr. Dolf de Roos wrote Real Estate Riches, which is part of the Rich Dad, Poor Dad series. It was actually the first property book that I read at the age of 19. And they put on a course, How to Build Your Property Fortune. There were a whole bunch of breakfasts and a lunch. And then they also did a workshop on Change Your Life and Wealth through Property and Financial Education. So I know that many of you that are online, might have been along to that. If you didn't, I certainly recommend going along to it next year. But what they did was they brought 3 thought leaders together. The first one was Dolf de Roos. And as I said to you, I was extremely proud and grateful to be involved in the event because Dolf, as I said, I attribute a lot of my success in property to reading that book, Real Estate Riches. And even though the book was written in the 90s, the fundamentals of what he goes through have certainly stood the test of time. And the other thing that I think is incredibly exciting is that Dolf was certainly the first international property investor. The first one that was well known and effectively got some sort of celebrity status. A lot of people know Donald Trump, but Donald Trump is still only an expert in American property, whereas Dolf has invested all over the world. He was originally born in New Zealand. He now lives in America, but has invested all over the place. And that for me is very important because, as you'll see later, it's one of the trends. Then we had Clem Sunter and also Robin Banks. And a lot of the 7 trends and the 7 skills and the 7 strategies we're going to go through tonight is a culmination of these 4 different areas in terms of where we got. So what's the first one? Well, the first one is focus on income. I think the biggest lesson that I learned through the global financial crisis, and particularly through dealing with high net worth individuals, is that those people that focused on income, whether they're the one-man band that owns a house or whether they're a property fund, they are the ones that not only have survived but actually thrived during these times. So any property investor that is focused on income has done well out of the last 3 to 4 years. Anyone that is focused on capital growth, be it a one-man band, be it some of the biggest funds in the world, they have literally tried to bet against winter. And unfortunately, winter always comes, and they've come short. And there's a huge amount of individual investors that have gone bankrupt. Some of the biggest property funds in the world have gone bankrupt. And if they haven't gone bankrupt, they've certainly lost their best assets. And so I think the biggest lesson here is that when you are focusing on an investment, you must focus on income. because income is what you can manage. Income is tangible. Capital growth is nice to have, and it's something, you know, that is very hard to control. And the other thing that I think is particularly important in terms of, you know, income and capital growth is that when you're actually investing, you need to be able to do the returns. You need to be able to get the right information and the right partners. And for me, I always say when it comes to international property, it's property in general, but international property even more specifically, there's only two things you need to do right. The first one is that you need to get the right information. Unfortunately, when a lot of people are investing, over 80% of people, South Africans that invest overseas, lose money. And the reason being is that the people they deal with, they don't get the right information. They're told when they invest in Dubai, there's going to be a lot of demand, and then, you know, there's no tenants. When they invest in Manchester in England, they're told there's going to be a lot of demand, and then there's, you know, because of students, and then there's 2,000 units outstanding. And these are the problems when they don't get the right information. And the second thing, which I think is probably even more important, is the quality of the partners. Because, you know, the quality of the partners will determine whether you can actually get the return on your property and what is actually happening with your property. And so one of the things that we specialize in is finding the right partners who can give us the right information. And if you can find the best of breed partners on the ground, then you can get the right information, and then you can be successful. You know, Clem Sunter, someone asked Clem Sunter, and he said, you know, what would you do based on all these scenarios going forward? And he said the most important thing is who you partner with. Who is going to manage your properties, and what is your return on capital? So again, what is your return on investment? What is the yield in comparison with the cash that you're investing? Because that is the most tangible component. And if you don't have a good partner, you know, I looked at a property, and I spent a month in America in 2010, and I decided at the time there was too much risk. And the main reason was because I couldn't find partners on the ground. I went to a place like Las Vegas, and I found properties there that were $80,000 that, you know, 4 years ago I could have bought it at, well, they were $320,000. I could now buy them at $80,000. But for me, I couldn't find people on the ground that I could trust. And the information they were giving me didn't make sense. And funny enough, one of the taxi drivers told me that 5,000 families, I can never remember whether it was a week or a month, but it's irrelevant, were leaving Vegas. And my gut feel just told me, you know, I don't see who's going to be my tenant here. And that's what Clem Sunter is saying. You've got to have the right partners on the ground to be able to trust them so that you can actually bring in the income. And very interesting enough, he did some research, Clem Sunter himself, and, you know, there's always this debate between the stock market and property. So let's take that off the table, and let's take the stock market. And if you take the stock market for the last 100 years, the FTSE 500, and you actually look at all the wealth that's been created, 2/3 of all the wealth that has been created has actually been in dividends, so that's income, and only 1/3 has been in capital gains. And I think that is so critical to understand in terms of the real investors and what they focus on. I wanted to share with you this graph because I think this is also very important when one understands what's happened in America as an example. You can see the trend line here in pink or maroon or whatever color this is, and then you can see the house price index in blue. And what most of us have done in the past is that we focused on capital growth, myself included. When times were great in the boom years from 2005 to 2008, I bought a lot of properties in South Africa, and, you know, it was this whole thing. I didn't necessarily mind if they weren't cash flow positive. I could chip in a bit of money, but it didn't matter because I was going to get great capital growth, and I would either remortgage or, you know, and I would release the capital, etc., etc. But it's actually a load of rubbish, because if you focus on income, the value of the property should be directly determined to the income that you can earn. And when you look here at the graph in terms of what's happened in America, you can see the huge boom and then the crash off the other side. And interestingly enough, all that's happened is that property prices have come back into equilibrium with the value of the income. And if you ask yourself about the properties that you bought that you're not happy about over the last 3 or 4 years, I'm willing to bet almost without fail that you somehow got that, those metrics wrong in terms of where you focused on capital growth and not actually on income. So just a quick one. That's the first one. The second one, and this one is very much from Dr. Dolph de Roos, and he talks about population growth. You know, one of the things that I've learned in property is that the fundamentals of supply and demand are the most important. If you focus on areas where there's more demand than there's supply, so you take a place like London, even though the market dipped after the global financial crisis, after Lehman Brothers went tits, they lost 15%, but within 12 months, that market had fully recovered. And the reason being, there was more demand than there was supply. In Australia, the market sustained right through the global financial crisis, and even in South Africa. And the reason being is that there's more demand than there's supply. But in areas like Dubai, in Ireland, where 1 in every 5 homes in Ireland now sits empty, in Cyprus, in Spain, and even in America. In America, 1 in 4 homes built in 2004 were actually stood empty. Everyone got so excited, and all that it was about capital growth. And what happened is you had an oversupply, and that caused the market to eventually tumble, many years later. And Dolph DeRose actually talks about the population growth and what is happening, and he uses a specific example of Japan. Japan has 120 million people, but it's expected in the next 20 years to be down to 100 million people. And when you take that into account, then obviously supply and demand is going to be out of kilter because, the population is declining in terms of where it actually is. So some of the positive areas that you need to look at where there's positive population growth is America, Australia, South America, Africa, the East, but not China, because China has a one-family policy, and then, specifically India. And then some of the negative places are the UK, Europe, anywhere where the population is aging and in decline. So a lot of the Western world, particularly Europe and England, is aging, and the population is in decline. The same as what's happened in Japan, and I'm going to go into Japan in more detail. I thought you might enjoy this graph. I pulled this off the World Bank yesterday, and it's the population growth around the world. And you can actually see, quite interestingly enough, when you look at this graph, and hopefully you can all see my little mouse here, but the places in negative decline are these places in purple. So interestingly enough, all of Russia, okay, which I find very interesting, all of Europe, most of Europe, including Germany, etc., and then if you look at areas where there's kind of 0 to 1% growth, that includes South Africa, interestingly enough. You've got all of China, you've got all of North America, and then interesting 1%, 1 to 2%, you've got Australia. Australia has bigger population growth than South Africa. I find that fascinating. You've got the whole of South America, and then you've got Mexico as well. And then lastly, the green and the yellow as well, you can see what's happening in Africa, and that I will explain a little bit later in terms of population growth and India and what is actually happening there. But it's just interesting, it's fascinating in terms of long-term trends, because it's these long-term fundamentals that will determine your success in the future. The third one that's very important is purchase price versus replacement value. Now, I've already explained when one's trying to determine the value of the property, you need to work on income. And a lot of people get confused and they use their gut feel. They have no sort of system or metric or calculation. You've got to be able to calculate that property on income. But the second thing that's most important is replacement value. If it costs 100 Rand to build a house and you can buy a house for between 40 and 50 Rand, would you agree that it is good value? Because you're literally buying a house at 50% of replacement value. Therefore, they cannot build that house for the same price. And I think the really important thing here is that when you look at new builds, so one of the downsides of Australia is that Australia has a legislation called FIRB, which is the Foreign Investment Review Board. And when we invest in Australia as a non-resident, we can only buy new investments. So we can only buy new land, we can only buy new flats, we can only buy new houses. And the downside of that is that we can't go and find a granny that is getting sequestrated, or a couple that's in divorce, or a bank repossession, because we can only buy new from the developers. And the second thing is, in America there's a lot of talk about this EB5, where you can get, effectively it's an investment allowance, it's $500,000, and you invest in a new build development. But for me, it makes absolutely no sense when I can buy investments at 50% the value of what it costs a developer to build something new. So the only reason they give away EB5s is because that they want to put it in an area where there's no growth, so that they can stimulate jobs, because you spend your 500,000 and you get 10, you supposedly create 10 jobs. But you must understand that you're buying a new build development, and a new build development won't be built unless a developer is making a margin. So I think that is extremely important. The second thing is, if you look at existing property, and some of the best opportunities around the world at the moment are in existing property. I mean, if you take America as an example, you're buying stuff in America at 40 to 60% of replacement value. So forget about what the highs were of 2007. What you need to focus on is that, again, if it costs $100,000 to build that house, and if I can buy it for $50,000, then I'm sure you can appreciate that that is real value. And it's one of the metrics that Clem Sunter speaks about so much in terms of the probability and then the comparison with regards to the replacement value. The fourth trend is property going global. And you know, there's the saying in South Africa, and I'm from Durban, so you're going to have to bear with me here, but ver van jou goed na aan jou skade. And you know, it means far from your possessions, close to your damage. And there's a huge amount of wisdom in that, but the world is changing now. You know, really, 10 years ago, it was about investing in your backyard. If you lived in Johannesburg, you invested in Johannesburg. If you lived in Cape Town, you invested in Cape Town. But the world is changing. It's going global. And with technology now, we have the opportunities to invest in the best sectors, the best countries, and the best properties globally, which will ensure that we get the best returns long term. And I often say, you know, my background is that my mother's from Durban. I'm 4 generations South African, and my father's from Zimbabwe. And we still own 3 farms in Zimbabwe. And my attitude with it is that it's not only prudent for investors to have global investments, it's downright irresponsible if you have all your investments tied up in one sector or even in one country. And it's got nothing to do with South Africa. Imagine if you had all your money in residential property in America in 2007. You would be feeling like a complete pawpaw right now. And the way that the world is going global really allows you to take advantage of these opportunities. When we asked Dr. Dolph de Roos, he said the trend of investing overseas is going to accelerate. And investors need to decide whether you're on the leading edge or the trailing edge of the curve. And I think that is absolutely critical. Again, understanding from these thought leaders the future and where it's going. But most importantly, again, it comes back to information and partners. If you want to be successful overseas, you've got to have the right information and you've got to have the right partners, because the right information will help you understand and isolate and take advantage of the long-term trends. It'll help you understand where the best areas are, where the schools are going, where the infrastructure is going, which way a city is growing, where the growth nodes are. And then you need the right partners so that you can take advantage of those opportunities. You need the best of breed partners that are on the ground, people that are investors themselves, that they too are taking advantage of the opportunities. And I certainly have found in my many years of experience that it is far better to deal with local best of breed partners who can deliver the opportunities in terms of where you actually are. One of those partners, a gentleman by the name of John Chin, who recently we were over in America and we were absolutely amazed by his knowledge and his experience. And he said something that I absolutely love. He said he would rather buy an average property with a great partner than a great property with an average partner. And I think that's the essence of property going global. You need to have the right information, but most importantly, you've got to be able to find the right partners. And on that basis, we actually have our USA buyers trip. So if anyone is interested, we're going over at the end of October. You can literally come over with us. And there's 2 reasons for coming on the trip. The first reason is that you can come and you can get the right information. You can understand why we are excited about the market. The second thing is that you can meet the partners. You can shake their hand. You can look them in the eye. You can see why I am so excited and my partners are so excited about the quality of the people on the ground. And the third thing is you can have some fun. You can come over and in 1 week you can see the best investment opportunities in the market, and you can actually take advantage, have lots of fun, get the right information, meet the right partners. And I actually agreed today with Dr. Dolph de Roos that I'm also going to be going, I think Brendan's coming with me as well. We're going to be going on with Dr. Dolph de Roos. So if you want to do the 2 weeks, our trip is from the 21st to the 28th of October. It's free. But if you want to come and learn from Dolph, ours is a buyer's trip where you literally are on the ground and you are going to see the opportunities, whether it's for Wealth Migrate or direct investment, doesn't matter, because you'll be able to experience the opportunities. And Dr. Dolph de Roos is from the 14th to the 20th of October, and that's very much an educational opportunity. But the beauty is if you were to do both weeks, you would get to see Phoenix, Vegas, Atlanta, Orlando, Memphis, and New York, which in our opinion are the 6 best areas in the whole of America to invest. The 5th trend is scenario planning. You know, where is the future? And Clem Sunter, he's actually an Oxford graduate. He was the chairman of Anglo American, and he came up with a concept right back in the 70s and 80s about scenario planning. You know, none of us can see into the future. None of us have a crystal ball better than anyone else. But what Clem Sunter came up with was And many of you would have heard of the talk that he did in the 1990s called The High Road and the Low Road. I wasn't actually aware until last week of how much detail he went into. Do you know that he met Nelson Mandela in prison? He met with the whole, I'm not sure if you call it the Broederbond, but call it the Avia Bear or whatever. He met with Parliament. He was involved with CADESA. His whole scenario planning in terms of the high road and the low road had a massive impact on the country that we are so privileged to have today. And that, for me, is one of the most important trends, because and I'm going to go into this. This is so valuable. We're going to have a whole section on this a little bit later. But the most important thing that Clem Sunter teaches is that none of us can see into the future. So there are different scenarios, and you need to have a plan no matter what happens. So no matter what scenario happens, you need to have a plan that you've taken into consideration. So if you want some more information, go to his website, mindofafox.com. You'll see all his latest scenarios in terms of where it is, and he updates it. I would highly recommend going and listening to one of his live presentations. I've now heard him 3 years in a row, and that's one of the reasons that I'm going to be able to share with you. And the most important thing that he teaches is that it actually comes from a Greek poet called Arkindle. And Arkindle spoke of two different creatures. They spoke of the fox and they spoke of the hedgehog. Now the hedgehog is a creature that has one big idea. It's the old school 1990s. A company would have a vision, they would have a mantra, and everyone would get behind the vision, and off they would go into the future. They would follow that vision and they would make it happen. And the problem is that the world is changing so fast at the moment. In fact, the only thing that we can rely on, the only certainty is that there will be uncertainty. And what you need to do in this environment is be much more foxy. You need to be able to adapt. You need to be able to change. You need to be able to adapt to changing conditions. You need to be able to invest in one country and then move, once the conditions change, to find other countries that are better. You need to change from one investment to another. You need to be able to adapt and move and take advantage and be a foxy entrepreneur so that you can take advantage of smaller opportunities. Because if you are a hedgehog and you have a massive vision and you're all walking in one direction and the world changes, you could just walk off the edge of a cliff. Those days are gone, ladies and gentlemen. Those days of the good to great and the big vision and the blah, blah, it's over. Because the world doesn't even change in 10 years. It doesn't even change in 5 years. Technology doubles every 9 months. And with all this uncertainty, both good and bad, you've got to be foxy in terms of where it actually is. Lee Krief has a question here. He says, hi, Scott. What would the cost of the trip be with you and your Dolph? I'm trying to go on the trip. Can answer me in the webinar. That's fine. Lee, definitely send me an email and I'll be able to help you with that. As I said to you, the trip for us is free. All that you need to do is pay your flights and accommodation, which you're looking at a budget of about $30,000. And then Mark said trend to smaller households might be offset by negative population growth. 100%, Mark, and that's why population growth is so important in terms of where you are. But coming back to Clem Sunter in 1988 actually went along, and he was head of scenario. He was the chairman at Anglo American, and he went along and he actually met a guy in Japan. He met them in London, but they were discussing Japan. This guy was based in Japan, and his name was Pierre van Wyk. He was actually also a South African. And Pierre van Wyk in 1988 said, I believe that Japan is going to crash. Now, Japan had just had a 30-year boom period, and Pierre van Wyk actually said, listen, and they said, why? And they said, well, it's one of the flags. And the flag is that Japanese businessmen are stopping their golf membership. And he said they love their golf, and if they're stopping their golf membership, there's something brewing. And he said the property market is going to crash in next year, so 1989. And blow me down, that's exactly what happened. The property market in Japan crashed, and it took the entire economy with it. It went from a growth of 7 or 8% to 1%, and the market has never recovered. And interestingly enough, the way I like to use the analogy, I'm a surfer, I'm from Durban. I'm very privileged to live on the beach now in Cape Town. And one of the ways I like to talk about the flags, because this is what Clem Sunter says, is that he says with scenario planning, he doesn't know the future any better than any of us. But what he does is he comes up with different scenarios. So just like you were swimming on the beach, if you see a green flag, then no problem. You can swim in the sea. If you see a black flag, well, that means that the shark spotter is not sure. Okay, so you better be pretty wary. If you see a red flag, it's a high shark alert, and I would suggest you get out of the water pretty quickly. And if you see a black flag, you don't even get in the water because there's definitely a shark there. And I love this analogy of flags and what Clem Sunter talks about, and I'm going to go into that in a lot more detail in terms of his planning. The sixth trend is, where's the best place in the world to invest? And someone actually asked this question both to Dr. Dolph DeRoos and to Clem Sunter at the Real Estate Investor magazine event. And Dr. Dolph DeRoos said, India and China have the best population growth in the world at the moment. And probably India will be the future of the global economy. But at the moment, the best opportunity right now in the world is America. Now, it's interesting because Warren Buffett has said the same thing. Donald Trump has said the same thing. Wall Street has said the same thing. The press has said the same thing. And most importantly, market sentiment in America is saying the same thing. And then you got Clem Sunter, who has nothing to do with property. And he said, America is a much better investment than Europe based on probability and price. And I'm going to go into this in a lot more detail. London is expensive as the prices have not come down. Australia, I would be concerned about China going into decline. And interesting enough, any of those that read my Australia report over a year ago, I said the number one risk to Australia is that China declines. And if China declines, then resources will decline. And if resources decline, then unemployment will go up. And if unemployment goes up, then it could have an impact on the Australian market. And I flagged that over a year ago in our Australian report as the number one risk. And here Clem Sunter is saying that is his concern in terms of what is happening. And he says you have to consider both the probability and the price. And let's go into that into a lot more detail. So the question is, where is the best place to invest? And I've already mentioned Warren Buffett, whether you're talking about the Wall Street Journal or USA Today. These are just some clippings. But for me, there's three reasons why myself and my business partners are so excited about what is happening in America. The first one is the story. You're buying property in America at 50% of replacement value. So between 40 and 60% of replacement value. Forget about what the highs were of 2007. We are extremely excited because at the moment you are being able to pick up properties at literally 40 to 60% replacement value. And the interesting thing when you come back to income is that the net yields are between 10 and 20%. The second thing is the timing. You know, it is so easy to call a market in hindsight and say, oh, I missed that market, or the bottom of the market was last year. I had a client today telling me the bottom of the market was 2009, which I certainly don't believe because having been to America many times. I believe, based on all the research and all the people I've spoken to, the bottom of the market was the end of last year. Now, the ship has started to sail, but that doesn't mean it's out the harbor. But if you wait too long, it will be out the harbor. Our partners in Atlanta that Henny and I went to buy stuff at the auctions in August, all those properties that they bought yesterday, they sold to a hedge fund, every single one of them. Now, if that doesn't tell you what's happening, then I don't really know what else will. And the third thing for me is the partners. As I said to you, I went to America in 2010. I spent a month there. I thought there's fantastic opportunity in the market, but I couldn't find partners on the ground that I trusted. And we went back with a different strategy. We pooled our resources. I partnered with a company and a guy by the name of Rod that I've worked with. He's a CA I've worked with since 2005. He's helped 1,100 British people invest. And I phoned him up, and he's helped over 6 years, 1,100 British people. And, you know, amazing numbers in terms of the yields and vacancies of less than 3 weeks across the whole portfolio. And so we went to meet his partners on the ground, his best-of-breed partners. And that was why we were so impressed that they had a full management and maintenance solution. And that, you know, because it's one thing to buy a property on a huge discount, but it's another thing to make sure that it's managed, maintained, and that you're collecting the income. And that is why, actually, I got the most excited about America, was that we finally had found people that were on the ground that could help us take advantage of this opportunity. Jay Trader has said you can't get financing as a foreigner in America. That's right, Jay. You can't get financing even as an American. It's actually very difficult to get financing, and that's the opportunity. That's why we can pick up properties at such discounts, because we are cash investors. But interestingly enough, you'll buy it in an LLC, and then after time, once the LLC is operating, you can look to refinance, which is certainly what we will be looking to do. The other side of the equation, if you go with Wealth Migrate, we will be doing bigger deals, which in the eyes of the bank are seen as commercial. So I'm going to talk a little bit later about our New York investment, and that's a $1.4 million transaction, and we've been told that we can get 50% financing from the bank immediately because it's deemed to be commercial right away. Marcus said Pierre crashed himself and skipped South Africa for a while, leaving creditors hanging dry. I'm sure it's someone very different, Mark. He's been dealing with, he's one of the heads of one of the Japanese banks in Japan. Okay, so, and Mark says you can get financing in America, but not from the banks. You're 100% right, Mark. It's called private lending or hard money. And you must be very careful in America, because what a lot of people are doing is they'll buy a house for $35,000. They'll sell it to you for $70,000. They'll ask you for a 50% deposit, and then they'll ask you to pay back the money at 8.2% or 10% or even 12% over the next 10 years. Basically, you're buying an overvalued property where they are lending you your money back and you're effectively paying them interest over time. Or you can look at it where it's private lending, it's mezzanine finance. My friend of mine is one of the top bankers at UBS. If you've got 10 million rand net asset value, they will fund your properties at 3.75% and they will fix it for 30 years. It is an absolute no-brainer. You're fixing it at 3.75 for 30 years and your net yield is over 10%. But the point of why I'm trying to say it is that the private money is being lent out in the 10 plus percent. It's no different to South Africa. It's mezzanine finance. It's nearly 3 or 4 times what you can actually borrow from the bank. Brian, you've asked, I'm a small investor, how do I get involved? Give me a bit of time, Brian, and I'll explain that to you, because that brings me on absolutely perfectly to the 7th trend, which is collective buying power. You know, the world has changed. For those of you that have used Groupon, you know, we used to have to go to restaurants, and it was a crazy thing where restaurants would sit empty and they didn't know how to market. And so a thing like Groupon came along, and Groupon went along to a restaurant and it said, listen, we've got all these people that are subscribed. You must give us a discount on the meal, and then we will market it to everyone. It's called collective buying power. And so now suddenly the restaurant's full. They're happy because they're making a profit, and the clientele are happy because they get a discount. And Groupon has grown into a massive business because effectively it's enabling the masses to work together to get collective buying power. Another example I wanted to show you was a website called Kickstarter. And this website is a website in America, and unfortunately it's only for Americans. But in the old days, if you went along and you wanted to start a new business, you had to go to a venture capital firm. You might run around and talk to 30 different companies and try and persuade one of them to finally let you, give you the money. One person, either a bank or a venture capital firm, to get going. Kickstarter says, no, bugger that. You don't need to raise $10 million from one person. Why don't you raise $100 from 1,000 people? And by doing that, I mean, they've had some phenomenal successes. On this particular website, there's one new watch design, and in the space of 2 weeks, they raised over $10 million. And so this is very much where the world is going. It's called social enterprise. It's called collective buying power. And the most important thing in terms of what is actually happening is that it's giving power to the masses in terms of what is actually going on. And something like Kickstarter is only available in America, and it's not available for property. And that is where, there's such an opportunity in terms of a trend. Crowdsourcing, that is when a whole lot of people come together and do something collectively. That is what social media and the internet has enabled, basically. Why should one person, in the old days, you had to buy a property, you had to go along to a bank. I want to buy that $1.4 million property. I need to go along to a bank. I need to try and raise financing. They want to look at me individually, and it's very difficult to do it. But the world has changed. You no longer need banks. If you want to start a business, like Kickstarter, if you want to buy a property, now you take advantage of crowdsourcing and collective buying power. And the future is that many people get together, putting in a small amount of money, which creates massive buying power, and that crowdsourcing allows you to do it. And at the end of the day, what's actually interesting is that we've gone full circle, because it's a blend of the law of nature and technology. I mean, when you look at birds flying in a flock, okay, when they fly, they always fly in a diamond. So you've got the main bird up the front, and then you've got the birds on the side. And these birds are the ones that work the hardest. These ones in the middle, chill, they fly. But birds, 25 birds flying in a flock can fly 70% further than a bird flying on its own. You look at any animal, whether it's birds, whether it's animals migrating across Africa, it doesn't matter. They work together, because by working together, they can achieve a lot more. And we believe that really what is happening now in terms of business is that you've got the laws of nature combining with technology. And with technology, it's enabling us to do stuff which will not only benefit all the parties, it'll benefit the environment, it'll benefit business, it'll be completely transparent, and most importantly, it'll be ethical. And by doing that, it'll open up the world. It'll change the paradigm. It'll change the way business has been done. And it'll certainly change the property environment. So the question is, you've got 7 trends. What is it that you actually do next? And I can see there's a question that's come here from Ricky Jack, and he says, is 10 million net asset value for private finance in dollars or in rands? It's in dollars, Ricky. So it's a you know, if you're an international investor, 10 million net asset of $10 million, then UBS will finance you. So there's just some funny things here, you know, in terms of what do we do. There's so much confusion. There's so much uncertainty. And that's why 3 years ago when I came across Clem Sunter's model, I thought it was absolutely fascinating. I shared it with you a year ago, and ironically it was August last year, so it's literally 13 months later. And what I did, I believe in life that knowledge is not power. Applied knowledge is power. It's pointless going and sitting to Clem and him explaining to you, you know, all the different scenarios, but then you don't actually build a model to be able to work out what that means. Now, we're an international property, so we need to understand where we want to invest. We need to understand what to invest in. So we took the scenarios, and I just want to give you a quick overview. And the intention tonight is not to do it if you want to go and read his book or go on one of his courses. But Clem, for the global economy, has 4 scenarios. The first one is hard times. The economy, the world economy, is flat, it's ugly, and it has low growth. And it's going to last anywhere from 5 to 20 years. And he says, if you think he's kidding, there was literally a boom period for the last 25 years, from 1982 to 2008. And in Japan, they had a similar boom. And yet, when they crashed in 1989, they've gone flat ever since. So there's no reason why it necessarily won't last for another 20 years. What he says is the financial crisis has not gone away. All that it's done is that it started with the banks, and now it's moved on to the governments. The European debt is $20 trillion. And he believes that Europe has about a 90% chance of following Japan. So literally, you know, declining and then just, you know, literally going sideways for 20 plus years. If you look at America, America has debt of 15 trillion. But the most important thing is that you've got to look at demographics. You've got to look at a country like Japan where the demographics were wrong. You know, the population is declining from 120 to 100 million. In America, the demographics are not too bad. Europe is even worse than Japan now in terms of the declining. It's an old age population that is declining. He made a joke in England. He said, you know, if you put a roof over any village in England, you'll actually have an old age home. And I thought that was pretty interesting. The other thing he said was the other place that's declining is Italy, which is quite bizarre considering that it's a Roman Catholic country. So the most important thing with the hard times is that it's going to be a corrugated U. There's going to be lots of ups and downs. Every time we think it's going to improve, it'll fall back down, and vice versa. I, to be honest, think, you know, very similar to what we've experienced for the last 3 or 4 years. The second scenario is the ultraviolet. And this is where the advanced economies, the old world, America and Europe, have a growth of between 1 to 2%. The emerging economies, the new world, China, India, Africa, will have growth of anywhere from 6 to 9%, 3 times more than the old world. The places to look out for are China, India, Africa, South America, and Australia. And the critical flag, which will determine whether we go into ultraviolet, is the China growth. If they can maintain growth of 6 to 8%, then, you know, there's a good chance that we can go into the ultraviolet. But if they stumble and they go below 5% GDP growth, then it's going to pull the whole world down. And what he said is that they've recently gone more negative on China. There's 2 reasons for that. Firstly, 38% of all their exports are exported to Europe, and we all know what's happening to Europe. And secondly, there's a lot of unoccupied property in China in tier 2 cities, and they expect the Chinese market to crash next year, very similar to what happened to Japan. I've actually heard in China there were 10 million homes oversupplied in America, and they reckon in China it could be as many as 60 million homes, where they've literally built entire cities in these tier 2 cities that are unoccupied. The third scenario is the one where they call it new balls, please. And like tennis, when the recovery comes, there'll be a complete change. America will recover next year, and it will actually drag, you know, the whole world with it, basically. The game will change. The East will become the economic equivalent to the West. the world will be running out of resources because everything will be pumping and moving, and Thomas Malthus spoke about it in the 1700s, and he spoke about a time when the population will grow so much that it will lead to starvation. We're going to start running out of critical resources like food and water, but most importantly, things like energy, oil, petroleum. He spoke about how a barrel of oil can actually go to $500. And he said some of the most interesting things will be that prices will force change. We've seen it in Australia where people are densifying. They're wanting to live closer to the city. But things like solar power and something Henny speaks about a lot in America is the size of the cars, the size of the cities, the distances that they travel. What sort of impact will it have if oil is at $500 per barrel? The two major flags for this are a drop in US unemployment and a drop in debt ratios. And in terms of the employment rate, it used to be as high, the unemployment used to be 9.5% in 2008. It's currently sitting at 8.1%, but they need it to be between 7 and 7.5% for this scenario to actually take off in terms of where we actually are. And then the fourth one, the scary one, this is the double dip. This is where we'll emulate the 1929 crash. And I think what's most important is the worst is still to come. In 1929, the property market crashed, the stock exchange crashed, and then it recovered. But it was 1932 that it really crashed. And it literally, by 1932, the value of a stock, if it used to be $100 in 1929, was worth 11%. And the one thing that is so important with this is that the two major flags are the US bond rates and a default by Italy or Spain. Now, at the moment, the US 10-year bond rate is between 1 and 1.5%. But if it gets up as high as 4 to 5%, then that's a major problem. Something else that's interesting is that the American Treasury, the Fed, is actually buying up 40% of its own bonds to keep the bond rate low. And obviously the debt to GDP ratio in America is something that is of concern. But the other one that he spoke of that was the biggest problem was a default by Italy or Spain. And he had a meeting 2 weeks ago with some of the top bankers, and they are very negative in terms of the consequences and the chances. And the European Central Bank has actually recently come out and said a very important statement that they're going to print euros to keep down the interest rates on the countries that are actually battling. But if this was to happen, one needs to be extremely conservative. Once it happens, there's nothing you can do. You literally have to go indoors and try and survive. And you have to try and make sure that your balance sheet has been structured right. This is going to be an extremely tough world. And what one needs to do in these circumstances is you cannot be in the stock market. You need to be buying properties and you need to be buying gold. And then lastly, in terms of something which I think you should check out, is a guy called David Huell. He's a futurist. And David Huell, I went to a talk at the SAPOA conference this year. And David Huell spoke about the golden age of Africa, the fact that we've got cheap labor, we've got population growth, we've got resources. And he said from 2020 to 2035, it's going to be the golden age of Africa. And that's something important to take into account in terms of the probability. So the question we have is, when we take all this into account, where does that actually leave us? So if you look at the probabilities, we've got hard times. Clem believes that there's a 40% chance of hard times. He believes that there is a 30% chance of ultraviolet. He believes there's a 10% chance of new balls, and there's a 20% chance of fork lightning. And very interesting enough, when I did this a year ago, that has swapped around. It used to be 20% new balls and 10% fork lightning. Fork lightning's gone up, and it's because of Italy and Spain. So let's keep going, because I'm going to explain it. Now, we've looked at the different scenarios globally, and there's always a debate as to what we should be investing in. David DeVet has asked if this is being recorded. It is, David, so don't stress. And, there's always a lot of debate, and there was research done by Barclays Capital over the last 10 years, from 2000 to 2010, about what was the best investment asset from their high net worth investors. And interesting enough, gold got 323%, oil 214%, fine wine 178%, property 109%, stock market minus 14. Don't argue with me. That's according to Barclays Capital. And the thing I find very interesting is that that was property which was bought cash. Now we've had, if we gear that property even at 75%, we start to get far better returns. And the most important thing that I think is that one needs to take into account here is that, we've had a property market boom and bust, and we've also had a stock market boom and bust. And so what I'm going to do with regards to Clem Sunter's scenario planning is I'm also going to look at property, I'm going to look at stocks, I'm going to look at gold, and I'm going to look at putting money in the bank, because these are the questions that we need to be asking ourselves in terms of where we actually want to invest. And then lastly, we've got to decide where we want to invest. Which countries are the best ones to invest in. And, I'm going to give you a very quick overview of the different markets. But, in America, the property market has lost 40%. The major reason for it was that they had a 10 million property oversupply, and they also had reckless lending. They literally, would lend to people if they had a heartbeat. And I don't have time tonight to go into it, but it was that caused the subprime crisis. And you can see here the graph with regards to the subprime crisis. It was all these reset mortgages where people got short-term mortgages on a 2-year, 3-year fix at very low interest rates for people that couldn't afford it. Dolph was telling us about mortgages where it's called a stated income loan. So you want to buy a house for $1 million and they tell you, oh, you need to earn $200,000. You might be earning $50,000, but all you had to do was sign a form saying you earn $200,000 and they would lend it to you. The problem is that's what caused the subprime crisis. And you can see all these reset mortgages going into default. That there was Lehman Brothers. And as you can see, this graph has moved on now. But this was the subprime crisis. And something else that's very interesting in America is that residential mortgages were on 2- and 3-year fixes. Commercial mortgages, there's over $1 trillion of unsecuritized debt coming through in 5- and 7-year mortgages. So something that commercial investors need to be very careful of. When you look at the American market, I think the most important thing when you take into account Clem and what he speaks about is that you've got to take into account price and you've got to take into account probability. And you can see here the huge growth in the American market and then the huge crash, over 40%. And then it's literally bumped along the bottom. And only this year have we started to see that uptick. The demand is back. But you're buying property at 40 to 60% of replacement value. In London, London's a different story. In London, we saw the crash. You'd lost 15% in the global financial crisis. But within 12 months, because the demand was there, within 12 months, that market recovered. It picked up the slack that the developers had, and it recovered by 17%. The most important thing that's happened in London is that the 10-year average for property transactions per month has been about 100,000. And since 2008, it has literally bounced around between 40 and 50,000. You can see the transactions here with regards to the latest research. The reason being, I've got a property in Wimbledon, a 5-bedroom house. I have a £270,000 mortgage on it, and I pay £26 a month in terms of my mortgage payment. The reason being, the interest rate is 0.5%. I have base minus 0.5%. Sorry, I have base minus 0.36%. So my interest rate is 0.14%. I could be on the dole and I could still afford my property. So you've got no motivated sellers that have to sell. And the second problem is that no one in England can get mortgages. A first-time buyer can get an 80% mortgage. They reckon the average age of an English buyer will actually be in the region of about 42. Okay, and that is why these transactions are so low, because you don't have motivated sellers and the buyers are finding it very difficult to get finance. And here you can see the growth in terms of the market. You can see the high growth over 2003, 2004. You can see the crash here in 2008. As I said to you, 15%. It then fully recovered by 17%. You can actually see it here. And since then it's fallen off. My biggest issue with London, and I own property in London, but my biggest issue with London is that I'm buying property at a value that is higher than the peak of 2008. And yet I still have all the risk plus the sovereign debt issue of Europe. And granted, there's good demand. I get solid rental demand for my London properties. But what worries me at the moment, if I'm buying today, if I can't get a discount on a property, then I'm buying at full market value. And I'm not sure that that's taking into account the risk factor in terms of where the global economy is, the fact that England has gone into a second recession, and obviously it's tied to Europe with regards to the sovereign debt. And then you've got Australia. And Australia is a very interesting market. It's a very fluid market. It's a very well-run economy. It's a resources-based economy. And they dropped their interest rates from 8.75 to 3% in 4 months when we had the global financial crisis. That's a 65% drop. The property market, it was the only economy in the G20 not to go into recession. The property market in 2009 actually grew by 8.6%. But then what happened is they dropped their interest rates too quickly. And so they were worried about inflationary pressure. So they started to put up interest rates. And over the last 18 months or so, they've actually put up interest rates 8 times. And because of that, in any property market, when interest rates are going up, the property market tends to slow. The cycle tends to slow. And that's exactly what's happened, so much so that they actually dropped interest rates twice. So if you look at the Australian market is, you're buying properties at full value. Here you can see the growth since 2000 and the ups and downs. You can see there was a small drop from 2008, but literally it recovered in 2009. As I said to you, the market grew by 8.6%. And then you can see here there's been a slight decline. It's actually kind of been going pretty much sideways in terms of interest rate. And here they're actually predicting here in terms of this housing index that it could even fall, slightly going into 2012, 2013. But I think the key thing in Australia is that it's a well-run economy. And I think, there's only 2 ways to get into Australia. You either have money or skills. So that population is growing, but it's only growing with sophisticated or wealthy people. And that is very important in terms of the supply and demand. The downside for me with Australia is that, as I say, you're buying at full market value and you're not getting the discounts that you can pick up in the likes of America. And when you look at over the last 12 months, you can see here some of the areas, there's been a slight downturn, as I said, in terms of growth, and that's because rising interest rates in terms of it, and then you can see the different capital cities. But I think the most important thing is that it just backs up what I was saying. The market has pretty much gone sideways in terms of where we actually are. And then lastly, South Africa. A lot of people ask me about South Africa. I am not negative at all. I am a completely passionate South African. I believe there's fantastic opportunity here in South Africa. I believe if you're going to invest in the emerging world, why not invest in a country that you understand, in a country where there's risks that you can manage? What about investing in a country where we've got our own population group? We've got the black diamonds and them all coming through. So for me, it makes absolutely no sense to take my money out of South Africa and go and invest in somewhere like a Mauritius or a Zimbabwe or a Cyprus, because that's just going from one emerging market to another. But when I invest overseas, I like to invest in first world countries with first world assets. But in terms of where South Africa is, according to the home index, you can see our nominal year-on-year growth, and it's actually declined here for the small properties. The medium properties have pretty much gone sideways, and then the large properties. And then the real growth, you can see again, the smaller properties has declined more dramatically, and then you've got the medium and the large. So it just gives you an indication in terms of what Clem talks about in terms of price versus probability. One thing that's very interesting, if you take property from 1966 to 2010 in South Africa, you can see the extrapolation. And if you take just that growth, and if you take the average price of property today, the average price in South Africa at 10% growth year on year, can you believe that you'll be buying a property, the average home in South Africa in 2050 for 46 million rand? Yes, you heard me right. 46 million rand. The last trend that really affects us as South Africa is the rand devaluation. I did research based on the Australian Housing Index and also on the ABSA Housing Index. I went back as far as possible. I took inflation rates into account. I took exchange rates into account. And if you had invested the exact same amount of money in South Africa or in Australia in 1978, 32 years later, you would have 350% more money if you'd invested in Australia. You'd have a net asset value of 3.5 million if you'd invest in Australia, and only 1 million if you'd invest in South Africa. And that is something we South Africans have to take into account. I'm sorry, but when you look at 20-year trends, it is something that was absolutely vital and critical. Don't get me wrong. Over a 5-year period, I honestly believe there's better opportunities in South Africa than in some of the first world markets. But over a 20-year period, over a 32-year period, it is an absolute no-brainer that you've got to be investing in some of the best markets internationally to be able to hedge your bet against currency devaluation. So just as a graph to give you a breakdown, Australia, the UK, and America. Australia has had an economic shift. It's close to China and it's in a growth economy. It has no debt. Its GDP in 2012 is expected to be 3.3. Its average property growth over the last 100 years is 9%. In 2009, the property market grew by 8.6. In 2011, it dropped by minus 2.6. I believe the risk is low because it's a very well-run, managed economy, and the opportunity is average. It's a very transparent economy. It's very hard to find great deals because everyone knows about them, and also because of FIRB, we're not allowed to buy, existing property. In the UK, they're coming out of recession. They've actually just gone back into recession, so I should maybe change that. They've got the European trouble. They've got £910 billion worth of debt. Their GDP is expected to be 1.6. Their average growth is 9%. In 2009, the market lost 15%. In 2011, it lost a further 0.5%, but it did recover in 2010 by 17%. The risk is average, and one of the reasons being is that it's an old age home tied to Europe, and the opportunity is also average because of the growth prospects of England if you take the next 30 years. And then America, it's in a growth phase. It's got structural problems. It's got $15 trillion worth of debt. The GDP is expected to be 1.8. The average property over the last 100 years is 9.75. Across the whole market, it lost 40%, and since then it's kind of been bouncing along the bottom. The risk is high. America is a massive place. There's a lot of dodgy deals on the internet, but if you've got the right partners and the right information, the opportunities are also great. And then lastly, South Africa, it's in a structural phase, but also structural problems. Our debt to GDP ratio is 11%. Our GDP growth is 2.8%. Our average property over the last 100 years has been 12%. In 2009, we lost 0.32%, and last year we grew by 1.1%. And I believe the risk is average, and the opportunity in South Africa, if you know what you're doing, is actually great. You can really take advantage of the market here. So let's look at the probability calculator and what that actually means, because what one needs to do is you need to take what Clem Sunter has taught us and actually give a scenario. So he's got the hard times, the ultraviolet, the new balls, and fork lightning. I've then given South Africa, the US, the UK, and Australia. And I don't have time tonight to go into the full detail. So let's just do hard times so that you understand it. I've given America the #1 spot. And the reason I gave America the #1 spot is that its downside is that it's got 100% debt to GDP ratio, more growth potential, it's got a growing population. You're buying at 40 to 60% of replacement value. That's the one that I think is the most important. It's the price. And then you've got strong yields. I think that South Africa is the second one. We managed the global financial crisis well. The banks are in a strong position. We've got growing population. We've got resources. Although politics is not making us as popular, the whole Marokana and etc. And then one thing that's a massive down for me is the property rights of property owners. I got arrested by the police, or nearly got arrested, because I locked a tenant out who hadn't paid me for 4 months, and I was the criminal. It makes absolutely no sense to me, and that for me is a major downside for South Africa. Australia is #3. The reason Australia has no debt, it's navigated the GFC the best so far, it's well governed, the banks are strong, it's got a growing population, it's close to China and got resources, supply and demand fundamentals are in place for property demand, it's got average yields, but prices are fully priced as no decline in prices. The biggest risk is a slowdown in China, which will affect resources, thus the economy, then employment, and then the demand and prices. A particular problem in hard times. And so that's why. And then lastly, the UK, I've got at #4, and it's got a huge debt at 80% debt to GDP, but also aligned to Europe, which has structural problems, aging population. Prices are also above the peak of 2008, which doesn't factor in any risk. You've got good tenant demand. And based on these, I rated the countries, America first, South Africa second, Australia third, and England fourth. Under ultraviolet, the conditions change. And again, I rated South Africa first. And the reason being is that this is where the world is, the emerging economies is where it's going to happen. We are going to be at the base of Africa. We are the gateway to Africa. There's an 80% more chance of companies being successful if they go into Africa with a South African, company. But it all depends on China. The second place is America. The same as the hard times, although still a positive investment in property as the US will grow. Unemployment will reduce, and thus it will fuel the property market. Demand and prices are coming off a low base with good yields. The third one is Australia. Australia is the first world country which included with the emerging economies, but it won't have as much growth as emerging economies as it's got a higher base. Has resources and well-located China. Property is still fully priced, though, with average yields. And then the fourth one is the UK, and I've put in the same as hard times. And then new balls, please. I've put America at #1. And I put here, it's got resources. In this scenario, America is going into full-scale recovery and drags the world with it. The flag is unemployment, and as this recovers, demand for property along with sentiment will improve quickly. Finally, resources will be expensive, and so the replacement value will be vital. As USA property is 40 to 60% below replacement value, the market will recover quickly. In South Africa, got resources, and also on Africa's doorstep, the next focus point is the golden age, that 2020 to 2035. And there's also huge food potential in Africa and in South Africa. And then third is Australia. It's resources heavy and also a sophisticated economy close to the east. In number 3, due to the problems with water and the fact that property prices are already at full value. And then lastly, number 4 for the UK, don't have any resources in the UK, is an old age home, and 70% of the GDP is based on finance and insurance, which they can move. They don't manufacture anything. And then lastly, for Fork Lightning, I had America at 1. I said they've got huge debt, however, property is being bought at a significant discount to replacement value. That allows for further shocks in the economy. Strong rental demand in America is due to population growth and lack of supply, so allow you to hold on and ride the economic wave while you survive. As you're buying cash, you are also not exposed to debt. Number 2, I put in here, the strongest is Australia, the strongest G20 country through the GFC, good regulatory environment, educated population who pays tax. Only problem is that property is at full value and does not allow shocks to the global economy. A slowdown would affect China, 38% of imports to Europe, which would impact Australia's resources demand. This would lead to unemployment and a decrease in demand for property. And then finally, the UK, not as heavily indebted as America, but is aligned with Europe, and the euro could collapse, which will directly affect their 2 major industries, banking and insurance. Also, you need to borrow money to purchase, and so you're exposed to debt. Still good demand if you own the right properties in the right areas due to fundamentals of supply and demand. So that then gives you a scenario. And then what I did is I calculated where, based on each country, which position it was in, and then based it on the scenario. The second thing I tried to do was I said, right, where do we want to invest? You've got the stock market, you've got property, you've got money in the banks, and you've got gold. And I said to, if you're looking at it, you've then got the 4 different scenarios. So the first one is I said that property was number 1 under hard times. And I said it's a lot of volatility, and so stick in the long-term investment. You have to make sure you buy at the right price, and also in markets where the fundamentals of supply and demand are on kilter. You need to focus on replacement value and income. The second thing was the stock market. The stock market will perform well, but you'll have to be very experienced as it's going to be very volatile. Gold always does well in uncertain times, but it doesn't earn any income. And fourthly, money in the bank, safe, but you're eroded by inflation and no incomes. Also very low interest rates being paid at the moment, always worth keeping some money in the bank to take up opportunities. So that's the scenario under hard times. Under ultraviolet, I've actually put the number 1 position, the stock market, because I said if you can choose the right companies in the right markets, then you'll see great growth as they grow quickly in these emerging markets. Property was number 2. You need a balance of getting great growth in emerging markets, but you need to balance it with the risk in this market. You also need to have investments in first world assets and income to offset the currency devaluation. The third one was gold. I said same as hard times, although less attractive in a growing economy. And the fourth one was money in the bank. This is not a good investment with low returns, although worth keeping some money in the bank. Under the new balls, please, property is the number 1. The reason for this is resources, even housing, will drive up prices in a high inflationary environment. It is why replacement value is so important when determining the purchase price. The second one is the stock market. If you choose the right companies in the right markets, then there will be great returns. But you will have to be very experienced in resources and efficiency and technology to make good returns. And then lastly, you've got gold. I said this will be a steady Eddie investment, but without income. And then number 4 was as a last review, but always worth keeping some money in the bank to take up opportunities. And then lastly, under Fork Lightning, I put property as number 1. Property and gold will be the only safe haven as it's an inflationary proof. You only have to look at Zim to see the proof of this. The Zim property market completely collapsed. But if you had good property in good areas in Orari or in Vic Falls or in Kariba, they were sold in US dollars and they maintained the value. And in fact, they actually grew because it was the only asset that held value. But you need to focus on income and demand for the rental property. Under Fork Lightning, I said the second best thing was gold. And this is a constant recession-proof investment. but it doesn't earn an income. With the lack of confidence in the financial system, people still want to go back to the gold standard. The third thing is money in the bank. Problem is that it will devalue with inflation as high inflation environment due to currency devaluation. Always worth keeping some money in the bank to take up opportunities. And then lastly, the stock market at number 4. The stock market will crash. It's a high inflationary environment and a global depression. A question that someone's asked me is, why haven't I taken into account Europe, places like France and Cyprus? You know, my logic is there's so much risk involved in Europe, and the population is aging. You've got the sovereign debt, the euro, and everything else. It just makes no sense to be investing in those markets. And to be honest, you're not even buying property at big discounts. You're certainly not buying it on good yields. And so it really doesn't make sense to me, with all the risk, to even have it on the scenario planner in terms of where we actually are. But what does that actually mean? Well, interestingly enough, if you balance out the 4 scenarios, because what Clem Sunter says is that we have to balance out the 4 scenarios, and we need to have a plan for all of them. So if you look at the different areas, you can see that America, across all different 4 scenarios, is the best place to invest. South Africa is number 2, Australia is number 3, and the UK is number 4. If you look at what the best investments are, property is the best investment, the stock market is the second best investment, gold is the third best investment, and the bank is number 4. And just to see why this probability calculator is so interesting, last year the probabilities were different, the scenarios were different, and interestingly enough, Australia and South Africa would tie first, America was in third, and the UK was in fourth. And property was first, the stock market was second, gold was third, and the bank was fourth. So that hasn't changed. But the countries to invest in have changed. And that's why, you know, yearly you need to be doing an analysis in terms of where you actually are and what is happening in terms of the market. So let's look quickly at his scenarios for South Africa. Are there any questions? Is this all making sense? Please let me know. No one's asked a question for a while, and I want to make sure that I'm not talking to myself. Actually, let's do a little poll. Let's wake up everyone and see who is what is the best country to invest in. So I'm putting out a poll, and before I move on to South Africa, tell me, what is the best country to invest in your opinion, based on what I've just shown you? Okay, so I can see that people are filling it in as we speak. I'll give you another minute or so. We can see that about 55% of people have voted. Those of you who are not concentrating, this is your moment to get active, get alive, and participate. I can see lots of you are writing in here, USA, USA. Do me a favor and actually vote. You should see the screen. You can actually vote, which you know, keeps you nice and awake and hopefully part of the equation. Okay, so I'll give it another 10 seconds. Let's just see there quickly in terms of everyone. Okay, let's close that out and share that. And you should be seeing the results coming up. Very interesting. 19% of people say South Africa and 81% of people say America. And, you know I've just shown you my own probability calculator, but isn't that exactly what that's saying? It's actually saying a balance between the two in terms of where we actually are. So I find that absolutely fascinating in terms of where we are. So thanks for participating. Good to see that you're all on track. Now, let's go into South Africa quickly. So Clem talks about there's 3 scenarios for South Africa in terms of where we are. The first one is what he calls the Premier League. And I can see, okay, there we are, it's come up. And in the Premier League, it's the top 54 countries in the world. There's actually an Institute of Management which comes out of Switzerland that regulates it. In 2008, we dropped as low as 53 because of the infrastructure problems and Eskom. In 2010, we got back to 44 because the banks weren't bailed out. But for the last 2 years, we've been 52 and 50 because of the policy uncertainty. And I'm sure with Marikana and everything else at the moment, you know, it certainly is a worry. It's ridiculous because we're the 32nd biggest economy in the world. There's no reason we should be in the 40s and certainly not the 50s. But it's because of this policy uncertainty. But we are the only country in Africa to be there. So scenario 1 is that we stay within the Premier League. We stay the premier country in Africa and we take advantage. Scenario 2 is where we don't get our ducks in a row. We are poor but peaceful. And the most important thing here is that it's disastrous for the government, because what will happen is a lot of people will leave, a lot of the educated people will leave, a lot of the business people will leave, and so there will be no tax and there will be no money. And when you consider that we need 750 billion rand to maintain our water infrastructure, we need 500 billion rand to look after Eskom. You know, the government certainly needs a good tax base, and they certainly need businesses and individuals to be paying their tax. The problem with this is that Nigeria will overtake South Africa by 2022. It's currently growing at 7%. We're growing at 3%. It means that Nigeria will join the BRICS. It means that South Africa will get kicked out of the G20. And, you know, these are obviously, you know, there's still good opportunities. You can make money, but as he said, we will be poor but peaceful. And then lastly, the third one is failed state. And this is where violence goes up. We become somewhere like in Afghanistan or Libya. It's so unpredictable that people actually turn their back. And the first flag here is the level of violence. And I heard a very disturbing report 2 days ago. It was a report done by Kasatu, and they said that they believe now the only way to get people's attention is through violent protest. And I then heard another report that we have an act of violence in terms of the riots and the you know the service delivery and everything now 1 every 2 days. And that, unfortunately, is why this probability has gone up. It's now up to 10% when you take into account Marikana and what our good old friend Malema keeps on going on about. The 4 flags for whether we are going to stay in the Premier Division or decline into the second division. The first one is nationalization. So, you know, he talks about Botswana, Namibia, and Chile, and whether, you know, the government is actually going to go for it. He believes that the ANC has put this to bed, and for this reason, the flag is actually down. The second flag is clumsy implementation of the health policy. And again, he said that he's met with a number of doctors and the medical aid schemes, and that the minister in charge of health is playing quite an active part in trying to make sure this is done properly. And so at the moment, that flag is also down. The media tribunal with punitive powers, this flag is up. You know, the secrecy bill is on the table. The ANC has watered it down, but you know, there's a lot of suspicion around it and what is actually happening. And then, you know, land grabs. You know, this is the most toxic, you know, with people like Ansel and Malema running around and telling everyone that, you know, they will take back the land and they can't afford it. Whether it's right or wrong, it still affects sentiment. And funny enough, he did something with ZANU-PF about a year ago. And ZANU-PF, Zimbabwe was the darling of Africa. It was growing in the 90s at 7 to 8%. And the moment that they took the land, the whole thing crashed. And even ZANU-PF said that they made a mistake. But something that I think is very concerning that he brought up was that we have our own Arab Spring. And he said, what are the 3 flags for an Arab Spring? He said, abnormally high youth, so an abnormally amount of young people in the country. Social networks so that they can communicate. And thirdly, alienation from the state. And he said the worrying thing is that South Africa has all 3 of those. And, you know, only going to take some sort of spark that we could end up having our own Arab Spring, where the youth just rise up and they literally just take what they want in terms of where they are. The flags for the Premier Division versus the second division is, the first one is inclusive leadership. Now, something I found incredibly positive here is that he spoke about how we had an inclusive leader with Nelson Mandela, and how Zuma and Thabo Mbeki have not done that, and they've very much divided the country. But what I found very interesting is that he said that we have an inclusive leader in the wings, and that is Kakleme Motlanthe. And so very interesting in terms of him running for president. And he pretty much said we cannot stay in the Premier League with a divided nation. The second thing is pockets of excellence. You know, we've got 28,000 schools in this country. 5,000 of them are unreasonable. 23,000 of them are shocking. The question is whether we dumb them down, the good schools, or whether we pull up the bad schools. And what's worrying is in KZN at the moment, they're looking at opening up the Model Cs. And then lastly, the balanced economy. And this is where we have enough exports to pay for our imports. And there's 3 areas of excellence that he talks about here. We've got our resources, obviously a resources-based economy, but we need to add more value. We've got tourism, and then we gateway to Africa, which we've spoken about already. And, you know, from an inward perspective, we also need to change our policy. where we have a far better attitude towards entrepreneurs, because we're never going to be able to create 5 million jobs. The only way we'll be able to do it is to create an environment for entrepreneurs to start small business to be able to actually do it. Now, David DeVette has said, Scott, have you considered the impact of the world US losing the US dollar as the world's currency and going back to the global gold standard? Very good question, David, and I have. It was my number one risk when I went to America. I met with my friend of mine that studied with me at UCT. He's now one of the top guys at UBS, which is one of the top private banks in the world. And I asked him that question directly. And he said to me, he said, Scott, there's two reasons that the world is not going to lose the US currency. Firstly, the biggest competitor would be China, and they're far too regulated. The world currency would never allow it. And secondly, the Chinese don't want it, because if the Chinese had it, the yuan would increase by 30% in value, and it will wipe out their manufacturing. The second risk would be Europe and the euro, but I think we can safely say that's off the table at the moment. So it was quite a big risk for me, but certainly it was one that I put to bed. And I can see, obviously, David is asking with regards to America. I would highly recommend, David, reading our ebook on everything you need to know about investing in America, because I cover all the risks, and that was the number one risk that I wanted to cover. With regards to South Africa, when I first heard Clem talk to 3 years ago now, he had a 60% staying in the Premier Division, 30%, you know, in the negative, in the second division, only 10% in the failed state. But unfortunately now we're in 50-50. 50% we're in the Premier Division, 40% in the second division, and 10% in the failed state. And he talks about how we're at the tipping point. We had our first tipping point when we had CODESA, and the way that we, you know, stopped the Civil War, but we need a second CODESA, you know, something for entrepreneurs so we can work out how to create jobs. You know, Steve Biko said, handouts do not improve your self-esteem. Doing it yourself does. We have to find a way through entrepreneurship to employ 15 million people. And the last thing that we need to do in this country is to be able to celebrate, you know, excellence. Now, let's look at the property calculator and what that all means. Because what I did is I took, here they are. So you've got Premier League at 50%, the second division at 40%, and then the failed state at 10%. And interesting enough, what I did is I then took the different countries and I took the different scenarios and I balanced out which would be the best countries to invest on, taking into account the global economy as well as the South African scenarios. And then I balanced the amount of money that one should be investing between locally versus offshore. So I did it for the Premier League. I also did it for the second division, and then I did it for the failed state. And I'm not going to go through it all in detail because I don't have time now, but what I do want to show you is the graphs. So in the Premier League, America is the number one place to invest, in my opinion. South Africa is just behind it. Then you've got Australia, and then you've got the UK. In the second division, America is the outright leader. South Africa is behind. You've got Australia, and then the UK. And in failed state, America is number one, Australia is number two, the UK is number three, and South Africa is dwindling a very low fourth. And the very last graph that I wanted to show you was that depending on which scenario you think is going to happen. So if you think we're going to be in the Premier League, then according to the scenario planning and the probability, you should be looking at about 70% of your investments in South Africa and 30% overseas. If you think that the no ducks in a row, the 50-50, then you should have 50% in South Africa and 50% overseas. And if you think we're going the failed state route, then you should look to have about 20% in South Africa and about 80% overseas in terms of where you actually are. So I can see there's a question that's come through here. James has said, how do we get your book on investing in America? James, I will send you the link afterwards. There's a quick survey to fill in if you don't want to pay the 199 Rand, and then you can get the download. Dustin said, Scott, when do we sign up for your USA trip? Dustin, I'll send you an email afterwards, and I can just send you the details in terms of where it is. I'm very nearly finished, ladies and gentlemen. I just wanted to give you an overview in terms of the probability. Just some interesting things, the difference between local and offshore investing. Local, the returns are higher than offshore. The property is easier to do locally than overseas. You don't have peace of mind if you've got a local investment versus offshore. In my opinion, you know, things like what is happening with the future, and more importantly, you know, if my tenant doesn't pay, can I even get them out? Financial planning for the, locally maybe, offshore yes. Rand hedge, locally no, offshore yes. And diversification, you can't have all your assets in one country and think that you're diversified. Offshore yes. Clem Sunter said, when I asked him the question, he said, with a 10% probability of a failed state, you would be crazy if you don't invest overseas, with at least a 50-50 probability. So there's a 50% chance of staying in the Premier Division. There's a 40% chance of a second division, and there's a 10%. So that's a 50-50 split. He believes that you should be investing 50% offshore and 50% locally. He said, don't go and invest 90% offshore, because that's probably too much based on the probabilities. But based on the current probabilities, the numbers that he believes is a 50-50 split in terms of where you actually are. So just in terms of the laws of the nature, I have already said, but 25 birds flying in a flock can fly 70% further. You can get on an airplane, you can fly over there, you can go and try and do it yourself. Why? Why not use the laws of nature? Why not use the right partners? Why not use our experience and the fact that we've helped over 2,000 people do this? I believe the greatest skill that we can bring to the table is being able to find those best-of-breed partners, being able to understand what the right information is. I spoke to a guy today by the name of John Chin, who's going to do all our due diligence on our projects. And he's actually got a website that he calls Deal Kill. And interesting enough, Henny made me aware of this. Henny's one of my business partners, and he made me aware of this. Warren Buffett, whenever Warren Buffett buys a property, he actually pays someone to tell him why not to buy the property. And John, when we, on behalf of Wealth Migrate, we'll be doing all our due diligence. So it'll be a third set of eyes where we'll be paying him to make sure that we're making the right opportunities. The kind of opportunities you've got, if you look in America, you've got direct investments. As I said to you, this is a beautiful 4-bedroom home. It's got a whole lot of facilities in place. Its purchase price is $86,000. The rent is $1,100. And that's actually with a 3-year lease in place at a 15% yield. It's appraised in today's value at $115,000, and it was sold in 2006 at $200,000. We have single-family homes, literally from like $40,000, and you're buying everything at 40 to 60% of replacement value. We've got a full management and maintenance solution. The opportunities are immense, and we've got 4 major areas that we're looking at, and each one of them is unique. Some of them have yields as high as 20%. So if you're interested in direct investment, let us know. Then we've got Wealth Migrate, and I know a lot of people are online tonight trying to understand what is Wealth Migrate. Wealth Migrate, ladies and gentlemen, is effectively, it's taking into account the laws of nature and it's blending it with technology. It's a number of sophisticated investors coming together and basically having collective buying power. It is taking advantage of all 7 of the trends, because that is what it is. That is what it does. You might ask me, why the word migrate? Well, do you know that migrate actually stands to go from one country or region to another, to pass periodically from one region or climate to another, as certain birds, fishes, and animals, as the birds migrate southward in the winter, to shift as from one system, mode of operation. So just like how the birds migrate, we are allowing wealth to migrate, to go from one country to another, to take advantage of the best markets globally, to find the best of breed partners, to get the best information, and then to have collective buying power to be able to take advantage of it. It is not a fund, and it is not a syndication. It is not a fund like Growth Point or Redefine, and it's not a syndication like ShareMax or Blue Zone. If it's a fund like tries to raise as much money as possible, and then the management company earns 2% on the investment, and whether the property is going up or down, they still make their 2%. If it's a syndication like ShareMax, ShareMax actually took 26% off. If you invested 100 Rand, they took 26 Rand off. You literally invested 74 Rand before the property had even started. And that, it didn't matter whether it was a good or bad investment. And then it was completely untransparent. You heard these terrible stories like Blue Zone, where they bought a property for 1 million Rand, and then they sold it to the syndication for 100 million Rand. This is not that. And the reason being is there's 5 critical components. We are different. We are not a fund, and we are not a syndication. The first reason, we have no fees. There are no fees up front. There are no fees in the middle. The second reason is that our interests are aligned. We are investors. We are investing with you. We are co-investing with you. And the only way that we benefit is that after we have made you a hurdle rate return, so once we have made you a return, then we benefit in the upside. I think that's fair, because what we say is that this is the expected return. If we can do better than the expected return, then we will benefit on the upside, but only after you have made a return. And secondly, if we do not hit the expected return, we get nothing, naught, zappa, zilch. So it literally holds our feet to the fire in terms of where it is. But I think what's even more important is we are co-investing. We are putting our money where our mouth is so that we are as actively involved, because our investment is involved as much as anyone else. We are looking to only do cash. All the investments are looking to be cashed. If we can increase the return by some low-level gearing later in the future, that is something we will look at. But at the moment, it is all cash, which completely mitigates the risk that a lot of syndications and funds got themselves into trouble. We are not either of those, but where they overgeared themselves. And the last one, and the one that I'm most excited about, is the transparency. With the use of technology, there will be complete transparency on a weekly basis, and the intention is to get it up to real time, where you literally will be able to analyze your asset. You'll be able to see the returns. You'll be able to see all the expenses. You'll know exactly what was bought and sold and what the fees were, so that there's complete transparency. There's complete integrity. It is the laws of nature. It is where business is going, ethically, morally, so that together a bunch of sophisticated investors can come together. They can have collective buying power, and they can all benefit because their interests are aligned. What are the 5 solutions that we provide and the problems that we solve? Firstly, we provide you access to global property. Property overseas is expensive. It requires a lot of cash. This, the minimum investment is $15,000. It allows you access to the best properties globally. It also allows you the best property investment expertise. We've got a highly sophisticated investment team. The partners we have involved have been in property and international property for decades. The best of breed partners that we have in each country are the best that you can find. They have an in-depth knowledge of global investment and, more importantly, property investment. It's complete simplicity. There's no complication. There's no fancy structures. It's a simple structure where effectively you can invest. The structure owns the asset, and it gives you wealth preservation, a plan B, and peace of mind. It reduces your risk because you can diversify. Henny's got a great saying. He would rather have 10% in 10 properties than 100% in one property. So it allows you to diversify, not only across markets, but across countries. Not only across countries, but across sectors, between residential and commercial. And most importantly, it eliminates the barrier to entry, because by collective power, buying power, by crowdsourcing, we can all come together as sophisticated investors, and we can take advantage of opportunities that are out there in the market. To give you a simple diagram, the breakdown of what we're looking at the moment is you've got Wealth Migrate. We've got commercial opportunities in Australia that we've got some great partners on the ground there. But right now, the real focus is the residential in America. It's the sweet spot. There's magnificent opportunity. And there's 2 things that we're launching. One is the income plan, and one is the growth plan. The income plan is where you hold for 5 years, and the growth plan is where you buy, you renovate, and we flip. And an example of the income plan is a building that we're in final due diligence today. And as I said to you, I was actually talking to John Chin about doing the deal kill analysis on this deal because we're that far down the line. It's this building over here in New York. It's 12 residential apartments. It's 3 commercial units. You've got the World Trade Center here. It's at Journal Square, so it's literally 2 stops. I mean, you're literally looking at about a 6 to 10 minute journey. And for me, it's very similar to how I've been successful in London. You're in the middle income areas. You're where middle income America wants to live, but you're close to the place where people need to work in terms of where you actually are. And for those of you interested, I can send you more information. But on a pure buy and hold, at a 3% capital growth rate, we're looking at an annual projected return of 14% year on year. Obviously, the intention would be to buy, renovate, and then look to mortgage. And if we can achieve that, the returns are much more exciting, up to sort of 20%. But for me, the really interesting thing here is the location, the partners, the building. It's a $1.4 million building that we can buy now that literally the moment we finish renovating it will probably be worth, based on income, in the region of $1.8 to $2 million. And the intention will be to buy it and to hold it for 5 years and to benefit from the income. And then the growth plan, Henny and I have been to the auction. We've stood on the steps. It's absolute pandemonium and mayhem, but we've got some fantastic partners, and this is one of our partners here, literally kicking the door down. A lot of people say to me, they would rather, maybe deal with an MBA student or whatever, but the bottom line is these guys, in the month of August, they analyzed 5,000 properties. They personally drove around and looked. This gentleman, RJ, personally drove around and looked at over 300 properties. Henny and I spent 2 days with him, 14 hours in the car, where we looked, at about 30 to 40 properties. But he'd been doing that for 8 days on the trot. We went to the auction with all the analysis. We had $2 million cash in our back pocket, and we only managed to buy 16 properties. So just to put that funnel, 5,000 properties, 300 properties looked at personally. We were willing to buy in the region of about 60 to 80 properties, and we only managed to buy 16 because they hit our criteria. And the whole idea behind the growth plan is where we put down the money, we buy the properties aggressively on auction, we renovate them, and then we sell them in the open market. And the expected return there is about a 25% return on investment. And one of the reasons that you can get that return on investment is that the property in America transfers so quickly. I mean, literally a property in America transfers in 4 days. So if you buy it on the first Tuesday of every month, by the next week you own the property, you renovate it over the next 2 to 3 weeks, and you can have it back on the market by within the same month. So literally, we believe we can roll our capital every 2 to 3 months or 4 times a year, and that's really the opportunity in terms of the growth opportunity. Now, I know this is not very clear, but this is a full synopsis. I have no intention of going through it, but if you are interested, this basically breaks down what the income plan is, what the growth plan is, and then what the commercial plan is. It gives you a full breakdown in terms of the synopsis, the target return, when the dividends are paid out, the capital investment, the minimum size, when it will be closing, the hurdle rate, the price per share, the number of shares, the target investment, the ownership, and the philosophy. And again, that's for someone to read in their own personal time. So in conclusion, when one looks at Wealth Migrate, what is Wealth Migrate? Well, Wealth Migrate is there to provide a global, self-service, crowdsourced property solution which takes advantage of local property markets through best-of-breed partners and collective buying power. It will be optimized through a global IT platform that will provide transparency and efficiency through property markets. And the most important thing is that it is a simple solution to buy global property aggressively with like-minded, sophisticated investors and to create global wealth. And again, we've all learned, and I've been through the 7 trends, but we really do have, an investment criteria. And for those of you that are interested, we call them our 10 wealth create paradigms. It's the laws of investing for this particular, for Wealth Migrate. Things like law number 1 will only be, the values will only be based on income value. Law number 2, each property will be personally visited. Law number 3, the investment committee will be personally invested. Law number 4, the best of breed partner will also, on the ground, will also be invested. Law number 5, the income has to pass the 100-point test at a 90% average. Law number 6, growth. We will only look for growth or believe that there will be growth if we can find a unique angle, refurbishment, a motivated seller, or an opportunity to create immediate value at today's value. Number 7, strategic investment in management and maintenance solutions so that we can keep down the expenses and increase control. Number 8, weekly updates so there's complete transparency. Number 9, returns are only based on external valuation or sales. And number 10, complete focus on creating wealth through global property opportunities. There'll be complete corporate governance. We're doing a lot of work at the moment with the guys from Grant Thornton, and in terms of setting up the structure and doing all the compliance, they're the ones that are setting the whole structure up for us. And as soon as that's ready, we will actually let you know. But that for me is really exciting, a very well-known brand, very respected in both South Africa and America, to provide that corporate governance, so that we don't come short like so many other opportunities. The strategic partners, I don't have time tonight to go into them, but we've got a number of people both locally and internationally. We've got decades worth of experience both in international property, in property development, in commercial investment, and between us with that experience, and then also with IT, which is critically component, because remember I said to you, it's the laws of nature blended with technology. So we believe that it's the strategic partners that give Wealth Migrate such value. And then lastly, with regards to the FAQ, if you are interested, let me know. I can send through the FAQs, but we've asked a whole lot of questions that we often get asked in terms of where we are. But if you are interested, let me know, and I can let you know. Ricky has said, is there a lock-in period for the investments? Yes, Ricky, for the income plan, it's 5 years. For the growth plan, it's 2 years. Dustin has said, hi, Scott. Are these slides available for us? I'd like to present to a partner. Yes, Dustin, I'll be putting them on YouTube, so you'll be able to. So just in conclusion, the next steps, if you're interested in direct property, give us a call, set up a meeting, ask us for all our research. As I said to you, I've got an ebook, and for someone actually asked for that ebook, so let me just show you quickly where you can actually go. If you go onto the RPS website, www.rpsinvest.com, you can actually go on and get our ebook. And all that I ask for in return is if you just quickly fill in. So if you go to solutions, you go to Wealth Migrate, you go to survey, and you go to American pre-meeting survey. So I just want to make sure it's come up on the screen there so that you can all see that. And where is it gone now? Just waiting for the screen to come up. But anyway, you can see the American pre-meeting survey. If you fill in that quick survey at the end, you'll get access to our ebook. And then we've also got investment guides on all the areas we invest in. So please just ask us if you're interested in that. In the different areas, I can take you through it. If you're interested in Wealth Migrate, we've got an expression of interest form. We literally, our money is, all three of the partners are moving their money over. It will be ready. Our money will be in place by the end of this month. The structure, I met with them again yesterday. We're very nearly ready now to fully set up the structure and have the bank accounts open. The intention is to have all the money in place, certainly within the next couple of weeks. And we're not going to wait. It's not about having hundreds of investors. We want a couple of sophisticated investors to get started and to take advantage of the opportunities. And then for those of you who want to come see it yourself, as I said to you, our buying trip is from the 21st of October to the 28th of October. It's free. So the only thing you have to pay for is your flights and your accommodation. The budget from the travel agent is about 30,000 Rand. And all that I ask for is that you put down a 20,000 Rand reservation deposit, because we only want to deal with committed, sophisticated people so that we can make sure that everything is set up smoothly. And again, when you're over there, there's three things that you will achieve. Firstly, you'll get the right information. Secondly, you'll meet the partners. And thirdly, you'll have some fun and you'll be able to take advantage of the opportunity. And as I said, I'll be going on Dolph's tour, which is from the 14th to the 20th. And if you're interested in that, please get hold of me, because I've also got some available information on that. If you can come and learn from Dolph, and if you do both weeks, you'll get to see Phoenix, Vegas, Atlanta, Orlando, Memphis, and New York, which in my opinion are the best 6 markets in America right now. So that's all from us. There our contact details are. You can see our website, ipsinvest.com. You can see our new website, Wealth Migrate, which very kindly Brendan, our partner, Brendan has put that all together. There's my email if you want to get hold of me. There's my number. Our blog with all the research that I've been through tonight will be there. You've got Twitter. You can follow up on us. There's YouTube. That's my personal account that I've been using for many years, and so I can't really move over to RPS. But if you go on there, I'll have this video, and then Facebook, you can actually follow us. So that's question time now. I do apologize. It's been quite long, but there's so much to share, so much knowledge in terms of the 7 trends, in terms of the scenario. And what I'm really excited about is that not only are the best thought leaders in the world talking about it, but if you look at the probabilities, if you look at the scenarios, if you look at the facts and figures, if you look at the research, it all points in one direction, to America. And it also points in terms of the global trends, in terms of direct investment, but also a new concept like Wealth Migrate, where we can take advantage of collective buying power. I can see there's a question here from Heather. I did the survey some time ago, but never got the book. Should I do it again? Yes, please, Heather, if you don't mind. I'm sorry, they only put the book up there recently. I missed the first hour. Is there a replay? Yes, I will send everyone the feedback. I'll put it up onto YouTube. David DeVette said, thanks, Scott. Just to confirm, 14th of October is the trip with Dolph. Yes, David. So from the 14th to the 20th is Dolph, and then from the 21st to the 28th is with us, looking at the other 4 areas that we are heavily investing in ourselves and meeting our partners. Marcus said, how is the benchmark set to determine over or under performance of Wealth Migrate? The benchmark mark is hurdle rate, and the hurdle rate is different for different investments. So, but it's all pre-agreed up front. It's a hurdle rate, and you need to look at the investment documentation. But the bottom line is it's agreed up front, and then the investor gets all the return up to the hurdle rate, and the partners in Wealth Migrate only share after the hurdle rate has been achieved. Okay, Peter's just asked me, property investing is tough, particularly offshore. Well, Peter, from our perspective, we provide a full end-to-end solution. We can actually help you set up your LLC. We can help you set up your bank account. We help you set up your income tax number. We help you find the right property. We help you manage the entire purchase property process with all the lawyers and the estate agents and everything else. And then we provide you with a full management and maintenance solution. And on the other hand, with Wealth Migrate, it's a hassle-free investment. We set you up with an LLC. We set you up with a bank account. Your LLC will own shares in the LLC that owns the property. It's purely a share certificate. You don't have to do anything in terms of the management. The Wealth Migrate investment team will look after that. Avinash has asked, what is the hurdle rate that must be exceeded? So look, Avinash, it depends on different investments. On that New York investment, because New York is New York, the hurdle rate is 8%. So it's the first 8% is going to the investor. And on the Atlanta investment, the hurdle rate is 11%. But those targeted returns of 14%, that is the total expected return. That is the conservative total expected return for the New York investment to the investor, so purely to the investor, and the 25% return on the growth plan is the expected returns to the investor in the growth plan. Okay, Koos has asked me, he says, property funds have no transparency. I think, Koos, the very important thing is that we are not a property fund, and there is complete transparency, and it's going to be used and built with our IT system. The intention, we're building a system at the moment. We are literally spending a vast quantity of money. I have a master's degree in IT, and my business partner, Brendan, is very sophisticated in both property and IT. So we come with a very strong blend of property and IT. And with that transparency, it'll actually give you greater transparency than direct ownership of property for yourself in terms of where you are. James has said, Scott, I'm based in the UK. How does that impact the structure and the way I can invest? James, it doesn't impact it at all. Whether you live in South Africa or England or Dubai, or I was talking to a guy today from Nigeria, the bottom line is we all deemed to be non-residents, and that doesn't affect anything. We set up the LLC, we set up the bank account for you, we set up the income tax number, and then we help you buy the right investments. So really, James, absolutely no issue. It doesn't matter where you live, we can help you facilitate and take advantage of the opportunity. Pam has actually asked me, she says, if I do it on my own, I can make more money and have more control. Pam, it's an interesting one. And again, this is where mindsets and trends need to be understood. The world is changing. 10 years ago, yes, you were 100% right. If you invested in a fund or a syndication or even a what do you call those old mutual things? I want to say trust, but it's not. Anyway, it doesn't matter. But you had no control. But the way that the birds migrate, the whole thing with Wealth Migrate is that it's providing great returns on direct investment. The partners are not creaming off the best assets. They're not creaming off all the returns, giving you very average returns in investments that you've got no control of. And really what we're doing is it's a new concept. It's, as I said to you, it's not a fund, it's not a syndication, but it helps you provide a balanced portfolio with a spread of properties. It reduces the risk, and the expected returns are actually far better possibly than direct investment. And the reason for that is because of collective buying power in terms of where you actually are. Okay, are there any other questions? I do apologize. I see we've gone on a long time tonight, but if there's anything else that I can help with, please let me know. Okay, I've got another question through here from Kim. Kim said, local investing is good. Why should I invest offshore? I mean, Kim, obviously we spent a long time tonight talking about it. Clem Sunter's got nothing to win or lose, and based on his probabilities, he suggests the 50-50 split. And, I did say it earlier, but I'm just going to repeat it. I think there's awesome returns in South Africa. but I think it's both prudent and wise, as a wealth creator, to invest some of your money in first world countries. And by first world country, I don't mean somewhere like Cyprus or Zimbabwe or Mauritius. I believe a first world country with a first world asset and first world income, where your property rights are protected, the fundamentals of property are right. When you look at Zim, Argentina, and Russia, more than 90% of the impact was directly impacted by currency fluctuations. And that's one thing when we live in an emerging market. I've shown you the graphs. We have to take, reconnaissance of that in terms of what is happening. And then lastly, I have mentioned again, but, even America was one of the, is probably the best place in the world, arguably. But at the end of the day, if you had all your money invested in residential property in America in 2007, you'd feel like a complete clown. And the whole purpose behind what IPS does and what Wealth Migrate does is that it helps you take advantage of the best opportunities internationally so that you can have wealth preservation, a plan B, and peace of mind. And really from my side and from all our partners who have been online, Brendan and Henny, thank you very much. It's a real honor and a privilege to have you online tonight. If there's anything else we can help with, please let me know. You've got my email, you've got my number, you've got access to everything there. Get hold of us, email me, tell me what you're looking for. I can give you all the details. If I've forgotten to answer a question tonight, go for it. I'm online, but I am conscious of the time. I can see that Lesejo said, don't put all your eggs in one basket. Diversity is the solution. Completely agree with you. Henny, who's one of my business partners and an extremely successful businessman, both in the business environment and in property holdings and property development. And he said, one of his business partners, who's another extremely successful South African, worth over R1 billion, and he said, it's exactly what Clem Sunter said. You can no longer be a hedgehog. You've got to be a fox. You've got to have your finger in lots of different pies. You've got to be constantly trying to find the best returns and the best investments. You've got to have the best partners. And with that diversification, it's exactly what Warren Buffett said. But most importantly, you've got to focus on the fundamentals. You've got to focus on information. You've got to focus on partners. You've got to focus on income. You've got to focus on replacement value. And then you've got to look at the different scenarios and you've got to make decisions based on that. Dustin has said, Magic, Scott, great presentation. Keen on the US tour. Let us know when you're next in Joburg and we can have a coffee. Perfect, Dustin. I'm actually coming up to Joburg on Saturday. I'm taking a week off with my wife on holiday next week. The reason being is that I'm going to spend a large portion of October in America finding opportunities for both Wealth Migrate and for our investors. So certainly in the first week of October, let's meet up in Johannesburg. For those of you that are around the country, we've got all our partners. We've got people based in Durban, Cape Town, Pretoria, Johannesburg. So let us know. My colleagues, our offshore wealth consultants, know what they're talking about. They've been doing this a very long time. They can sit down with you, understand what you're looking to achieve, and help you find solutions. And Mark said, who is behind Wealth Migrate? Only IPS or others too? Mark, it's a good question. It's three partners. It's myself. It's a gentleman by the name of Henny Besadenhout, who owns his own company, and another gentleman by the name of Brendan Brown that also owns his own company. We're coming together with our unique set of skills, and then we're bringing on external partners. As I said to you, we're working with Grant Thornton at the moment to set up the whole structure. We've got all our best of breed partners, and they vary. In Australia, we've got commercial partners. In America, we've got residential partners, and it depends on which sector of the market and where you are. So ladies and gentlemen, that's all from me. I can see hopefully that I've answered all the questions. If there's anything more that I can let people know, then please do. Mark said maybe do a little info brochure on the players in Wealth Migrate. I have got that, Mark. It's all in our investment documentation. So if you are interested, let me know. I can send that through to you with a full explanation of how it all works. So that's all from my side. I would like to finish off and just say, at the end of the day, be very proud to be a South African. I believe that we, being on the tip of Africa, we've got a massive opportunity, as David Houle said, as the world wakes up, and the golden age of Africa, 2020 to 2035. But we also have the opportunity to take advantage globally of the best assets. And whether you do it as direct investment with IPS or whether you do it as with collective buying power through Wealth Migrate, either way will have benefits. And I certainly know, because I'm extremely excited. I haven't seen opportunities in the market like this in my lifetime in property investment, and it's why I'm spending so much time in America at the moment, investing my own capital and my own time in terms of the investments. So thank you very much. I really appreciate your time. Lecheso, awesome presentation. Thanks, Emil. Thanks to all of you for being online. I really appreciate it. If you've got any questions, let me know. But otherwise, have a great evening. I'll put it on YouTube. And most importantly, I look forward to helping you get started or continue on your international investments so that you can invest with confidence, you can have wealth preservation, a plan B, and peace of mind. Good night.